Following Trump's tariff announcements, we've seen some notable moves in fixed income markets, in turn impacting mortgages. I'm Fiona Cincotta at StoneX, and to talk me through this and more, I'm joined by Managing Director and Head of Agency Mortgage Trading, Matthew Johannes. Thank you for joining me, Matt.
Thank you for having me.
So Trump's tariff announcements have wreaked havoc across financial markets. What are the moves you've seen in fixed income, and in turn, how are these affecting mortgages?
So, April was a pretty volatile month. Since the Liberation Day, when Trump announced the tariffs, we've seen, extreme volatility across the market. This has been on par with what we saw during COVID and various other high volatility scenarios where we saw, deleveraging across the system. And, with vol spiking, we had a very large range of rates, which pushed durations kind of around across the product. Depending on what you follow, whether it's VIX, 1-year, 10-year swaption vol, the MOVE index, any of these things are kind of at their, stretched valuations, where you kind of have a scenario where it's hard to pin durations within the fixed income space. So into these massive, sell-offs. So we went from, 420 on 10s to 390, then all the way back up to 460 on 10s. It's forced our customers to kind of have to reprice risk continuously, and then also readjusted durations throughout the time. Some of the beginning deleveraging we saw is the initial announcements came from basically April 2nd to April 4th, were initially around treasury and basis unwinding trades. That pushed rates a lot higher as swaps moved lower, and it eventually started to trickle into agency mortgages, where you saw mortgage funds starting to delever and kind of push that basis wider as well.
Yeah, so I was going to say, what does this mean for mortgages then? What have we seen?
So, as we kind of, bounce around a pretty large rate range, it creates a lot of difficulties for customers, I think, to decide where to be on the stack and decide, what exposure they want to have going forward. In addition to a sell-off, we've also had a very large steepening of the 2s-10s curve, which has in a lot of ways, the largest effect on the agency mortgage product. Agency mortgages tend to trade around a 7-year duration. That's the bulk of the mortgage basis that people are used to. It's an amortizing product, so it has a lot of key rate durations across the full curve. But in general, when you have a curve steepening like that, so 2s-10s moving from 40 to 70 basis points over a couple days, different parts of the mortgage stack will perform very differently. In general, the market has been kind of overweight agency mortgages versus credit for the last 1.5 to 2 years, as there was concerns of how tight credit spreads were versus other products. In general, one of the things we track is the index OAS on corporates, so basically IG corporates, and anything that falls in the Barclays aggregate, or now Bloomberg aggregate index, and mortgage OAS. That spread relationship got as tight as like 33 to 40 basis points. And it moved a lot wider into the Trump announcements as credit widened more than mortgages. So in some ways, while, mortgages, all risk assets underperform, mortgage assets actually outperformed in that scenario. So, going forward now, as we kind of look at that and as the market feels like it's starting to, relax and calm down a bit, the question becomes, where do people kind of go going forward, right?
Yeah, I was going to say, looking ahead, what do you see as sort of like the key drivers of overperformance or underperformance?
Yeah, so I think in general, the question becomes, if you have, credit very wide and other non-agency type products at a very wide spread level, there's almost two directions we can go. If we get further clarity from Trump and from the U.S. stance on tariffs going forward, it could develop into where vol kind of drops. And if there's a risk on tone, I would argue that the marginal buyer probably likely goes into credit products, and maybe in lieu of selling some agency mortgages to get into an area that should outperform going forward. The other side of that, which is the reason you're not seeing that happen in massive size yet, is because people are still so unsure of the effects of the tariff policy, right? If we start getting poor data, if the market starts to turn the other direction, corporates inherently have an exposure to credit, right? And agency mortgages do not. So there could be somewhat of a flight to quality bid as the economy maybe further slides towards a recession. And if that's the case, you can make the argument that agencies start to outperform and credit continues to widen. We saw those type of scenarios happen during COVID when there was immediate uncertainty, all spreads widened in conjunction and everything went to a 1-for-1 correlation. But then as we kind of started to get a feeling of how the world was going to react and how the Fed was going to react to the products, there was a initial flight to quality of treasuries, flight to quality of agency mortgages as, people wanted less and less exposure to credit. That changed very fast. That was a very quick time horizon. When people think about COVID, it was only, a 1.5 month type scenario where we were in a massively unsure period. The Fed came in and bailed everything out and we moved in another direction. But now we're kind of almost at a month with these tariff talks. And if you get a further continuation of something like this, it could create even more volatility. And in that case, maybe mortgages start to naturally get a flight to quality bid.
Yeah, excellent. Well, thank you so much for sharing that information with us. Plenty to be watching out for going forward. Thank you.
Definitely. Thanks for having me.
For more videos like this, please do like and subscribe.